Okay, so let's start with a mental image. You're standing on a dock, you're looking at one of those massive container ships,
Right.
stacked 10 stories high with steel boxes carrying everything from sneakers to semiconductors.
The scale is just incredible.
It is. It looks like a marvel of modern engineering, heavy, industrial, precise. But if you look at the insurance contract that's actually keeping that whole thing afloat financially, you're not looking at something modern.
No, not at all.
You're looking at something that feels like it was written with a quill pen by candlelight.
That is a surprisingly accurate description. I
Yeah.
mean, we tend to think of insurance as this hyper-regulated bureaucratic grid.
Totally.
You buy car insurance, there's a standard form, the state regulates the rates, everything is standardized.
It feels like filing your taxes.
Yep.
But ocean marine insurance, which is what we're unpacking today, it's the complete opposite.
The Wild West.
Exactly. The source material calls it the Wild West of the insurance world. It's largely unregulated, highly negotiable, and based on rules that haven't changed much in centuries.
And unregulated is the key word there.
Yeah.
Because there's no standard government form telling these parties how to behave, the market had to invent its own mechanism to prevent fraud.
Okay.
And that mechanism is this ancient legal doctrine called utmost good faith.
Utmost good faith. It sounds almost religious, but in this context, it's actually a pretty brutal legal standard, isn't it?
Boy, it is. I mean, think about the logistics of the 18th century, or even today, really.
Yeah.
An underwriter is sitting in a coffee house in London or an office in New York.
Right.
You come in and say, I have a ship in Mumbai filled with silk, and I want to insure it for the voyage to Liverpool. The underwriter can't see the ship,
Can't inspect the cargo.
can't interview the captain. He is flying completely blind.
So the entire transaction just rests on the assumption that you aren't lying,
It's more than that. It rests on the assumption that you are disclosing everything material to the risk,
whether they ask or not.
whether you're asked or not. And if you fail to do that, if you breach that utmost good faith, the courts don't just deny your claim, they can void the contract from its inception.
Wow.
It's as if the insurance never existed.
So it's not just we won't pay for the den. It's you have zero coverage for millions of dollars of cargo.
Precisely.
And this leads us to what I found to be the most fascinating part of this whole thing, the implied warranties.
The invisible rules.
Right. In my home insurance policy, if it's not written in that 50-page packet, it doesn't apply. But here, you're saying there are these strict warranties that are never even written down, but if I break one, I lose everything.
Correct. They're implied by law. They are just as binding as if they were tattooed on the hull of the ship.
So what's the big one?
The big one, the one that causes the most litigation, is seaworthiness.
On the surface, seaworthiness sounds pretty objective. The boat shouldn't leak, it shouldn't have a rusted out hull. That seems like a pretty low bar.
And if it were just about the metal, it would be simple. But seaworthiness in ocean marine law it's a dynamic concept. It implies the vessel is fit for the specific voyage.
What do you mean?
Well, a ship that's seaworthy for a trip down a calm river might be legally unseaworthy for a crossing of the North Atlantic in December.
Ah, okay. But the sources highlighted something even trickier, the human element. You can have a brand new ship, state-of-the-art radar, perfect engines. But if you put a captain at the helm who doesn't know the route,
Or a chief engineer who isn't certified for that specific engine.
then the vessel is unseaworthy.
Right.
That blows my mind. So the incompetence of the crew can actually void the entire insurance policy.
The entire thing.
Yeah.
For the ship owner.
Mhm.
Precisely. Because the underwriter insured a functional maritime venture,
Right.
not a suicide mission run by amateurs. If the owner creates the risk by hiring incompetent people, that utmost good faith is broken. The underwriter didn't agree to that risk.
It puts a massive burden on the hiring process. It's not just an HR issue, it's a coverage issue.
It absolutely is.
Okay, what about the cargo itself? There was an implied warranty there, too, something about the condition of cargo.
Yes, this one is pretty logical, but still very strict. The cargo owner guarantees the goods are sound and properly packed.
So if I just toss a bunch of porcelain vases into a crate without any bubble wrap and they arrive as dust, I can't claim that as a peril of the sea.
Exactly. The insurer is covering you against the violence of the ocean waves, storms, collisions. They're not covering you against your own, laziness in packing.
Right.
If the packaging isn't sufficient to withstand the ordinary motion of the sea, that loss is on you.
The other implied warranty that stood out was no deviation. This feels like it really limits the captain's freedom.
It does, a lot. The rule is that the ship must follow the agreed-upon route without any unnecessary delay.
You can't take the scenic route.
You cannot take the scenic
But
route.
why is the insurance company so obsessed with the specific path? I mean, if I get from point A to point B, why do they care if I swim by point C along the way?
It all comes down to the math of risk. When the underwriter quoted you a price, they calculated the probability of storms, piracy, and traffic along a specific line on a map. If you decide to deviate, say, to stop at a port to pick up some cheap fuel or just to avoid a headwind, you have completely altered the risk profile. You've exposed the ship to hazards the underwriter did not price in.
So if I deviate, and then 10 days later I sink in a storm that had nothing to do with the deviation?
Doesn't matter.
Really?
Doesn't matter. Once you deviated without a valid reason like saving a life or avoiding a hurricane, the coverage ceased. It vanished the moment you turned the wheel.
It's incredibly binary. You're either on the route and covered, or you're off the route
Yeah.
and totally exposed.
As it's the nature of this business. It's strict because the variables are so massive.
So we've got these invisible rules governing the behavior, but let's talk about the physical risks, the metal meeting the water. This brings us to hull coverage.
Which is, well, it's exactly what it sounds like. Insurance for the ship itself.
But even here, the language gets very specific. I loved the distinction the sources made between perils of the sea and perils on the sea. To a layperson, that sounds like a distinction without a difference.
It sounds like legal hair splitting for sure. But it's crucial for coverage. Perils of the sea are things that are unique to the maritime environment.
Like what?
Giant waves, stranding on a reef, sinking, collision. These are things that generally cannot happen in a parking lot.
Right. A giant wave doesn't hit your car in Kansas.
Exactly. Perils on the sea are things that happen while you're on the water, but aren't necessarily caused by the ocean's nature.
Like a fire.
Fire is the perfect example. A ship can catch fire, but so can a house.
Yeah.
Lightning, earthquake.
And my personal favorite coverage line item, pirates and assailing thieves.
It is remarkable that in 2024 we still have a standard clause for pirates.
It feels like we should be wearing tricorn hats or something, but it's a real risk.
A very real risk in places like the Gulf of Aden or the Straits of Malacca. But notice the phrasing, assailing thieves.
It requires force.
It requires force. If someone sneaks onto the ship at night and steals a laptop while the crew is asleep, that's usually considered pilferage, and it's often excluded or carries a high deductible.
Okay.
But if men with AK-47s board the ship and take the cargo by force, that is piracy. That is covered.
So violent theft versus sneaky theft.
That's the one.
Now, there's a term here that sounds like a legal term, but is actually a plot point for a thriller movie. Barratry.
Barratry is the nightmare scenario for a ship owner. It refers to willful misconduct by the captain or crew to defraud the owner or the insurer.
The insider threat.
It is. This is the captain scuttling the ship, sinking it on purpose, to hide the fact that he sold the cargo on the black market.
Or a crew smuggling contraband that gets the ship seized.
Exactly. And typically, this is excluded.
You'd think so.
Well, it depends on the policy, but historically, insurers were very hesitant to cover barratry because it implies a breakdown in that utmost good faith. If you hired a crook, why should the insurer pay for it? However, modern hull policies often do include it because the owner is actually innocent in that scenario. They were the victim of their employee.
Speaking of things that historically weren't covered, let's talk about the Inchmarie Clause. This seems to be a specific patch for the industrial age.
That's a great way to view it. The old perils of the sea language was written for wooden sailing ships. But as ships got steam engines, boilers, complex machinery, new types of accidents happened.
Like a boiler exploding.
Right. There was a famous case with a ship called the Inchmarie. A pump was damaged due to a clogged valve. The court ruled this wasn't a peril of the sea. It was just a mechanical failure.
And the insurer didn't have to pay.
Didn't have to pay. So the industry kind of panicked.
I bet.
They realized their standard policies didn't cover the internal machinery of modern ships. So they added the Inchmarie Clause. It explicitly covers bursting boilers, broken shafts, latent defects in the machinery, and accidents caused by crew negligence in handling that machinery.
So it updates the software of the policy to version 2.0.
Yes, exactly. Recognizing that ships are machines, not just floating wood.
Okay, I want to drill down into the money side of this, specifically the deductible, because this is where I had my aha moment reading the material. In every other insurance I have, a deductible is simple subtraction. But marine insurance uses something called a franchise deductible.
This is one of those concepts that once you understand it, you realize just how differently this industry thinks.
Okay, so Walk me through the math to make sure I've got this right. Let's say I have a shipment with a $10,000 franchise deductible.
Okay, $10,000 is your threshold.
If the ship hits a storm and my cargo suffers $9,900 in damage, what happens?
You get zero.
Zero.
The insurer pays nothing.
That feels standard.
Yeah.
But here's the twist. What if the damage is $10,100? In my car insurance world, the insurer would pay $100.
Right, they'd subtract the deductible. But with a franchise deductible, if the loss hits $10,100,
Yeah.
the insurer pays the full $10,100.
Yeah. They go back to $1.
$1 coverage. Once you breach that threshold, the deductible effectively disappears.
That is a massive psychological shift. It
Yeah.
basically says, we are not here for your scratches and dents. Handle that yourself. But if you have a real loss, we will make you whole completely.
It eliminates the administrative cost of small claims while fully protecting against catastrophes. It's binary. You're either hurt a little or you're saved completely.
I love that. It's efficient. Now, moving from the hull to what's inside. We have cargo insurance and we have freight insurance. And I think for most people, freight is a synonym for cargo.
Right.
But in maritime law, freight means money.
Correct. Freight is the revenue. It is the fee the shipper pays the carrier to move the goods.
So why does the carrier need to insure a fee?
Because of the risk of non-delivery. Think about the business model. You're a ship owner. You pay for fuel, you pay the crew, you pay port fees, you sail all the way across the Pacific. If the ship sinks 10 miles outside of Los Angeles, or if the cargo is destroyed, you generally don't get paid the freight charges.
So you've incurred all the costs of the voyage, but you lose the revenue at the finish line.
Exactly. It's a double loss. You lost the asset and you worked for free. Freight insurance protects that P&L. It ensures that if the voyage fails due to a covered peril, you still get your shipping fees.
That is a crucial distinction. Okay, we have to talk about liability, the running down clause.
This is the collision liability coverage attached to the hull policy.
The name sounds aggressive, but the coverage is shockingly narrow. I was reading the list of exclusions and I kept thinking, well, what is covered?
It's very, very specific. The running down clause covers the ship owner's liability for physical damage to another vessel caused by a collision.
Okay, so ship hits ship, covered. But what if I crash into a dock?
Not covered by the running down clause.
What if I hit a bridge support?
Not covered.
What if I crash into another ship and the collision causes an oil spill that pollutes the harbor?
Pollution is definitely not covered.
What if I injure the crew on the other ship?
Bodily injury is not covered.
This feels like a trap. You have collision liability, but it leaves you exposed to arguably the most expensive things: environmental cleanup, personal injury, infrastructure damage.
And that is why no commercial ship relies solely on the running down clause. They all buy protection and indemnity insurance, P&I. P&I picks up almost everything the whole policy excludes. But the running down clause is a relic of a time when the main worry was just, breaking the other guy's mast.
It's a jigsaw puzzle where you have to buy the missing pieces separately.
That is a perfect analogy.
We're entering the final stretch, and we have to tackle the concept of average. In school, average is math. In marine insurance, average means loss.
Right.
And this leads to the most socialist concept in the capitalist world: general average.
Socialism on the high seas is a common nickname for it. And it's a fascinating mechanism for survival.
So let's paint the picture. A ship is caught in a typhoon. It's taking on water. The captain realizes the ship is too heavy. If they don't lighten the load, everyone dies.
A terrible decision to have to make.
So he looks at the cargo manifest and decides to throw overboard 50 crates of heavy machinery belonging to Sony. The machinery hits the water, the ship floats higher, rides out the storm, and arrives safely in port. Now, Sony has lost millions.
Right.
Samsung, who had crates right next to them, lost nothing.
In a normal world, Sony takes the loss. But under general average, because Sony's sacrifice saved the entire venture, the ship, and everyone else's cargo, everyone shares the loss.
So Samsung has to write a check to Sony.
Effectively, yes. All the cargo owners whose goods were saved, plus the ship owner himself, contribute a pro rata share to make Sony whole.
That is incredible solidarity. Your loss saved me, so I will pay for your loss.
It has to be that way. Imagine if the captain hesitated. Imagine if he stood on the bridge thinking, if I throw those crates over, I'm going to get sued by Sony. In that minute of hesitation, the ship could sink.
So general average removes the financial hesitation.
Exactly. So the captain can focus on saving lives and the vessel. It prioritizes the survival of the group over the property rights of the individual.
And then we have the opposite. particular average.
Which is just a partial loss that affects only you. A pipe bursts and ruins your specific box of textiles. The ship wasn't in danger. No one else was saved by your loss.
So you bear that loss alone.
You bear it alone, or your specific cargo insurance pays for it.
And that's where the free of particular average, or FPA, clause kicks in.
Right. FPA is a way for insurers to limit their exposure. If a policy is free of particular average, the insurer is basically saying we are not paying for these partial isolated losses. Unless, and there's usually an exception, the loss was caused by a major catastrophe like stranding, sinking, burning, or collision.
So if it's a minor accident, you're on your own. If it's a disaster, we're here.
That's it.
Before we wrap up, there's one duty that applies to everyone involved. The sue and labor clause. It sounds like you're suing the workers, but that's not it.
No, sue here comes from an older meaning, like to pursue. This is the duty of the insured. It basically says you cannot be passive.
You can't just watch the ship burn and think, sweet, I have insurance.
Precisely. You have a legal obligation to take all reasonable steps to minimize the loss. You have to act as a prudent uninsured.
I like that phrase. Act as a prudent uninsured.
If the fire breaks out, you man the hoses. If the cargo is wet, you try to dry it out. If you don't, if you just let the damage get worse because you know the check is coming, the insurer can reduce your claim by the amount of damage you could have prevented.
It forces you to have skin in the game even when you're covered.
It aligns the incentives. Nobody wants waste.
And finally, the silent killer of logistics budgets. Demurrage.
Demurrage is simply the cost of delay. If a ship is stuck in port for 3 weeks because of a strike, or because customs paperwork is wrong, the ship owner charges fees for that time.
And does the fancy ocean marine policy cover that?
Almost never. Delay costs are standard exclusions. If your goods are stuck and the meter is running, that comes out of your pocket, not the insurer's.
Which brings us right back to the start. This whole system, from the implied warranty of seaworthiness to general average, it's all designed to keep trade moving in a hostile environment.
It is. It's a system of shared risk and extreme trust.
And that's what stuck with me the most. We live in a world of GPS tracking, blockchain supply chains, and satellite imagery. We can see everything. Yet the financial backbone of global trade is still this concept of utmost good faith.
It's remarkable, isn't it?
It makes you wonder, though, as we move toward autonomous ships, ghost ships with no crew, driven by AI, tracked by sensors every millisecond, will we still need good faith?
That is the billion-dollar question.
If the insurer has a data feed from the engine room that's more accurate than the captain's log, does the honor system just become obsolete? Or is there something about the unpredictability of the ocean that will always require a human promise at the core of the contract?
I think as long as the ocean can throw 50-foot waves at us, we're going to need partners, not just algorithms.
A comforting thought, or maybe a terrifying one, depending on how much you trust your partners. Next time you buy a coffee mug, think about the pirates, the jettison cargo, and the invisible warranties that got it to your desk. Thanks for listening to The Deep Dive.
Pleasure to be here.